Down here for now and tag everybody as one. All right, so we will be going over advanced market structure today in reference to make sure everybody's in here. Give her a few minutes. Actually, I don't even know who's in here right now. Okay, give Jake a few minutes. Get in here. See if he sees this. Go from there. We'll be going over advanced market structure. I know you guys remember strong highs and strong lows, and let's look at some characteristics of what I look for. Let's just say on the 1H, um, in terms of actual candlestick closes. Let's Let me see here. Let's pull that over here. Actually, no, that's not what I wanted to do. Give me a moment and pull up Australian dollar Swiss franc on a more blank chart. Okay, so what I look for in terms of market structure, relative to strong highs. So you guys already know about strong highs, strong lows. We will be reviewing what I look for in terms of market structure and how the algorithm kind of like delivers price and what true market structure really looks like. A lot of people, when they think of market structure, they think of lower highs and lower lows for a bearish trend, right? And then higher highs and higher lows for a bullish trend. Drop one in the chat box if you're familiar with basic market structure. Perfect. So a lot of people think of it like that, and those actually don't matter. That is what's being created, technically speaking. And that's a way to think of it. But there are inner workings in price action with how the algorithm delivers price that I'm going to show you. And then with this market structure that I'm going to show you, this will kind of be like a two-part live. We'll also be showing you the new way to draw in the order blocks. The old way where you draw in bearish engulfings, as you see here, for example, and bullish engulfings is still valid, but there's different types of order blocks that the algorithm is not respecting that you're going to need to know. So obviously, if everybody and their mom on YouTube starts buying and selling off bullish and bearish engulfings, eventually smart money is going to figure that out. And once they do, they're going to start stopping people out at these bullish and bearish engulfings. So I put one in the chat box if that makes sense. That as a retail trader, anyone which is in the United States of America, it's really anybody trading anything less than $100 million in capital. That could be personal capital or for like your firm or whatever. If you have like one of those firms, so if you're trading anything less than $100 million, you are considered a retail trader. And if you're got to the part, you trade for 10 years and you're trading $100 million in capital or more, you're considered an institutional trader because you have institutional level money, right? So that's kind of the difference, right? The whole spiel when it comes to retail traders. All right, so getting into the lesson, Australian dollar Swiss franc is very short. Um, Currently, basically any pair paired with the where the Swiss franc's not dominant currently is selling to the Swiss franc. Drop one in the chat box if that makes sense because Switzerland's economy is pretty resilient to like 99% of things in the world. And right now, China, Australia's economy piggybacks directly off China. So if China's doing bad, so is Australia. If China's doing well, so is Australia. It's an Asian region country. That's kind of how this correlate just for fundamental knowledge. Um, so the first thing you notice here, right, is a strong high, right? You can see that they obviously took buy side liquidity right here. Let me see. Do I have? Okay, I'll just change this text. I don't know why that deleted itself. Strong high. So drop one in the chat box if you can see this strong high on the 1H right here that was created. And you know it's a strong high because it never got violated, and obviously you started to break down in the bearish kind of structure going downwards. Took buy side liquidity here and everything. So if you're bearish like I was today on Australian dollar Swiss franc, and like I said, the setup it set itself up today, but I'm probably gonna try to trade it tonight for like a short gain. Where's buy side liquidity? I just saw here it is. For a short gain. So I took some buy side liquidity, stabbed into those highs right there, basically into this order block right here above, and then had a continuation down. So if you were looking at that, you could have easily gotten an entry if you just looked above the all of the highs, right? Where it's stabbed above the liquidity, which is one of the confirmations you look for before you even think about going short, right? And this trade is also, and we'll get back into the market structure thing in a second, it's all relating. This trade is also based on the fact that, let me zoom out, just completely based off the daily. Daily had a big impulse move from August 31st down to December 21st. And then now, right, in January, retraced back up into this bearish order block right here. Drop one in the chat box if you see that. Took out some buy side liquidity itself, actually, up to here. And then that's what I noticed here. You know what I mean? All of my trades are based off the daily. So I noticed that it came into it and sniped to this order block right here in this area, and price didn't start to break down. So I was doing the current price action to see what it was likely to do. I looked down. It's definitely chasing these this sell side here on these lows, and with this drop, you can see that they're between this candle and this candle right here, there was an imbalance. Drop one in the chat box if you can see that. So I expected that daily imbalance to be filled essentially, and then a continuation from that. Just to give you an idea of like higher time frame wise, what I was looking at for this trade. Okay, so now we're gonna get back into the structure thing. The thicker lines are gonna be the daily imbalance. So I'm down on that 1H now, right? And I have noticed that there's an order block. So first we'll start with, before I get ahead of myself, first we'll start with the order block theory. It's not really a theory, it's a fact. I don't know, I mean, I really don't care what anyone says. This is an actual fact because facts can be backed up with evidence. A theory turns into a fact once you have evidence. Drop a one in the chat box if you see this wick right here on this bullish candle. I'll even zoom in a little bit more actually for you guys to the specific area. Where is that one thing? This is one of my favorite tools. Perfect. Drop one in the chat box if you see, and you can zoom in the price or zoom out of price using the zoom tool, by the way. You have to kind of like highlight over the area as you just saw. If you can see the wick on this bullish candle right here, we're gonna get really close into price action. You see that wick? Okay, so you notice how if you look over to the right where the H1 actually respected, and we'll get back in there in a second, the entry was actually on the bottom of that wick of that bullish candle. So take this lesson here for the blocks and take it with the utmost importance. I know some of you see that. Oh, sorry, my bad. Some of you see that sometimes and you're like, why did it not come up to the body or the equilibrium and basically retest at least the body and then have a continuation? Why did it fall short of the body? So for bearish engulfing, for bearish order blocks, it will be the last bullish, the last up close candle before the break of structure. So you can see, and sometimes that, you know, in reference to how I used to teach you how to draw an order box down, I look pretty. What happened here? It took sell side liquidity, right? The last up close candle, which was this one right here, you see it? Before this move happened that took liquidity, think of it like that, got retested and respected right here and right here, and even in this area right here. Actually, it ends right here. So at the bottom, the very bottom of this wick got retested twice. Do you see that? How perfect that entry would have been? You had two entry opportunities right there. If you just look to the right where the wicks were relative to the crosshair. Perfect. Let me minimize this actually. Okay, so it'll always be the last up candle in premium territory, and you should use that before that took the sell side liquidity if you're looking for a short. So if you have more of a wick, as you can see here, you're going to highlight that bullish candle. And let me zoom in. And you can see that the body is small, but the wicks on both sides are large. Drop one in the chat box if you can see that. So relative to that, you're going to draw your order block as just the wick, right? Just the wick of that bullish candle. If you have more wick than body. In the case of having more body than wick, you're going to, and the body of the candle is defined in full. For example, this, you know, let's see, I'll find an example. For example, this one right here, this is an actual bearish engulfing, and they're still valid. But when you don't have a bearish engulfing, when you bearish engulfing is going to be last resort basically for order block you draw in. When you have a bearish engulfing, it has to be because it's the only one there, right? This is the only option available. So with that being said, you're going to draw, we have the ones like this, you're going to draw it from the from just the bottom wick, right? Drop on the chat box if you get that. Just the bottom wick. That's only for specifically when you have a situation like this where the wick is more, there's more wick than there is body of the candle. And you can see how it got respected. That's why this didn't stab all the way into equilibrium. It's because the algorithm now reads order blocks like this, depending on how much wick or not it has. And so once again, that doesn't invalidate bearish engulfings. As you can see, this one got respected as well in order to even create this one. But this specific one was the last bearish engulfing before the liquidity take right here for sell side. That's the ones you're going to focus on when you're in that situation. So make sure you take note of that and draw that in just like that. So for cells, if you have one that is more full and you have more of a body on it, then in that case, you're going to draw only on the body to body. So let's just say, like this one right here obviously had more wick. The one that we were just referring to had more wick than body. So in that case, I would just draw it from the wick to the top, the bottom of the body right here. And you can see how it was respected. Drop one in the chat box if you can see that. So it's up to you to really use your discernment to be like, is there or is there not more wick than body? In that case, you can zoom in and see the body's pretty small compared to the wick, actual wick right here. And I can highlight that for you quick. That's the wick right there, the entire thing. So you're gonna draw it in just like that, where you're focusing more on the wick because there's more body. You can be as precise as you want to. And you can see how it got respected. So that's how you draw in bearish order blocks when you are in that situation. And then you count on it being respected. And as you can see here, it got respected. These are going to be A grade order blocks, the ones that have the bearish order blocks that have the wicks and also the ones that have the full bodies. You're going to want this pattern right here. And it doesn't matter if it's in the engulfing or not, right? It doesn't matter if it's an engulfing or not. Engulfings are still valid, but this is going to be your lowest probability order block now, not your highest probability order block. You only select these order blocks when let me actually highlight that. You only select these order blocks when you have nothing else. So drop one in the chat box if you get that. Only these order blocks right here, this bearish engulfing, you can have literally nothing else, right? Perfect, perfect, perfect. So that's an example of two of them that got respected on the way down, one before the liquidity take. And then technically speaking, if we're thinking in terms of structure, this wick right here, the bottom of this wick for this bullish candle, let me zoom back in real quick. But you got to really get up and close and personal. Technically, this wick right here, once this candle stabs down below it, that's a sell side liquidity take. Drop one in the chat box if you get that. And remember, it's above the swing highs and swing lows. So this is a swing high. This is the highest wick right here. And this is in this like price action here where the order block was created, the swing low, the lowest wick. Once that was stabbed at, what happened? The next candle perfectly dug into that order block. Which drop one in the chat box if you can see that. Perfectly dug in that order block. And then price took sell side, took buy side again later on, should be today, into that same order block, and then had a continuation in the 1H. These would have been the confirmations that you were looking for. And then on top of that, you're looking, the context that you're inside also of this daily fair value gap. So you right now you have an H1 order block respected by solid liquidity take inside of an H1 imbalance for the continuation after you're looking at the 1H respect and order block as well, which in this case is a bullish engulfing and it's fine. And have a continuation from there. Just bullish engulfing or bearish engulfing is going to be your last resort. That's the lowest probability order block. Your highest probability ones are going to be the ones, the last up candle before the drop. Doesn't matter if it's engulfing or not. Once you see the last bullish candle happen before the liquidity take, that's your order block. And if you need help filtering that out, obviously you're going to use your discount premium fib in order to discern that. Where is this order block, right? In premium territory, up here, above the 0.50. Drop one in the chat box if you can see that. That's how you filter your order blocks. If you're ever not sure, draw it on the impulse move from here, from leg to leg, and then you will be able to see from here up, these are my order block selections potentially. And whichever one gets respected is the one you go with. Obviously, you're not going to draw on this order block because that's going to be liquidity. It has to trade above some type of high. So it's the same thing for buys. Just real quick. Let me see if I can find it. Perfect. This has to retrace at some point in which it has to buy from a buy side from a bullish order block. And in the bullish order case of a bullish order block, it's the same thing. It's going to be the last down candle before the buy side for the liquidity take. As you can see right here, traded above this high right here. There's a liquidity take. This is a potential order block that you could use. In this case, it seems as if there's more body than wick. Let's see if it even respected it at the body so far. Sometimes it takes a second to come down where it's supposed to. Not really. So I think that this is gonna likely still come down a little further into this bullish order block. If it doesn't, if it violates this one, it can only come down so far because once again, they're on the way up. There are strong lows. One of them is gonna hold in order for the retracement to happen. And you know what I mean? You have to make sure that you are drawing your order blocks incorrectly, right? So if I'm going down, focusing on where all these buy side liquidity takes happen, this would be an order block, except for this one would be bullish engulfing, in which I would use the wick because there's more wick than body right here. Drop it in the chat box if you see that. It'll be a last down candle before that closed before the liquidity take. This is actually the last down candle. This is the last down candle before the buy side liquidity take happened. That's your bullish order block. In this case, there's more wick than body. I'm just going to focus on the wick, focus on getting the tip really nicely in there, and that's your bullish order block or for buys. If there's only a bearish engulfing or a bullish engulfing in the area, that's fine to use that, but that's your lowest probability order block. When the body's full, use the body. When there's more wick, use the wick, right? So at that point, you can have a mindset of using the process of elimination, right? If this one fails, I know it'll likely go to this one. Obviously, mark up strong highs and strong lows as they happen, so you can have some some selection, some process of elimination, right? You're like, it's very likely to be this one because it's the last strong low that was created. It's very likely to be this one because it's the last strong low that was created, or this was the last strong high that was created. So it's very likely to be this one. And this one is in premium or discount territory. And you know what I mean? It's above where liquidity take happen, you know what I mean, et cetera, build context, right? So that's pretty much order blocks. Like I said, these are still valid, but it matters as just to the last up candle before the liquidity take. The one that's actually responsible for the liquidity take is going to be your bearish order block, and vice versa. Bearish engulfings are still valid, but you're going to use those as a lower probability order block. Basically, if you don't have one of the other two, then you're going to, that meet those characteristics, then you're going to try to find a bearish or bullish engulfing. Drop one in the chat box if you get that. I know there's a lot of information, but going through and spotting these are going to be your best friend. All right. So moving on to the structure part of this real quick, and we'll obviously add and review as the lessons go this order block theory, where I'm showing you why it comes up short of the equilibrium or the bottom of the body, is because you need to draw them in a little differently now due to the algorithm changing. So whenever I'm in, I want to, like, if I don't know if this is going to retrace back up for me or not, it will. You just have to draw out the bullish order block that it will likely retrace from, and it's going to be somewhere on this big impulse leg. So I draw them all in a row if you'd like, and then you can use process of elimination. One of them is going to get respected, and then you'll like bet the retracement starting, and you can expect maybe a limit order right here because of the context you have. I would put a limit order on this because it's a high probability order block or trade based on the daily. So what I look for in terms of structure, right? We're familiar with strong highs, right? So after your strong highs created, we have what is called an intermediate term high. And I'm gonna make this, I'm actually taking this and simplifying it because it would take so many lessons for you to really get the details of this. You have an intermediate term high. Basically, you want to rely on what I like to call the power of three. Let me delete this real quick. It's gonna be taking too much space. The power of three. You have, like, let's just say for shorts, right? You have the move down, the big impulse move down, right? Highs created, liquidity is taken, new strong high is formed. That's your strong high. I don't know why I didn't save the template last time I typed this, but I'm going to do it this time, I promise. It makes things so much faster. So that's your strong high. Drop it in the chat box if you can see that. Perfect. So what do you mean in reversals? Yeah, like this is the way to tell when prices, essentially, what you're looking for in terms of like how the market structures itself after the liquidity taken, what you're looking for on your 1H time frame, all the way down, and this is the only actual structure that matters. So everything, like if let's just say you're using the 1H to enter on the 5 minute, or let's just say you're using the 1H to enter on the 15 minute, everything will be based off this 1H structure. So you have your initial strong high, and then of course after the strong high, price usually ends up creating a low, still no trade, and then it shows you, boom, taking sell side liquidity here. Hey, I am officially chasing sell side, right? So that's your sign to go start to look to go short. Drop one in the chat box if you get that, because this is still technically a higher low, and there's nothing stopping this once price is at. I keep doing that. Once price is at this point right here, there's nothing stopping it from continuing, right? Because if you're looking at just basic structure, this is actually a higher low. You have to wait till a price shows you a tan and actually digs into the sell side and or buy side if you are, and that's where the displacement comes from, right? If you're looking for a long or short market, you'll have a displacement higher. There's your manipulation, and a displacement lower. There's your signal to that their algorithms taking the sell side, and then you act on the trade based on institutional footprints, right? Pretty simple. Um, and this is specifically on the 1H, by the way. So this is going to be called an intermediate term high. And essentially, your intermediate term high should not be broken. I just put ITH. You can spell it out if you like. I don't like to. It just makes things more cluttered. So this is your intermediate term high, and then there will be a third high that will form after that. And then there will be a continuation from there. So you will have your third high be called, pull up the templates, your long-term high. There you go. My bad, not long-term high, that's the wrong template. Where's it at? Internal high, internal low, and long-term high. That's also my bad. That's also an intermediate term high, right? Sorry. So you have strong high, price will go down a little bit after strong high is created. Still no trade. Price will come back up. Strong high should not be broken as usual. And then the second high that's created, right? It's called your intermediate term high. Price will come down, take some more sell side right here, finally show you like, hey, I'm ready to sell potentially, and then come up and make another intermediate term high. So as you can see right here, the highs are not broken, right? You can enter on not the first strong high, but you need more evidence than that. After the sell side liquidity take, you can enter on your first intermediate term high right here, since it shouldn't be broken. Drop one in the chat box if you get that. This is called the power of three. 1, 2, 3. And this is how market structure works. So as you can imagine, for a long, it would be a strong low, intermediate term low, and then another intermediate term low, and you can enter on your third. You can really enter on your second, but you really want to make sure that strong high doesn't get violated, because if it does get violated to the upside, for if you're short, you know what that means? Your trade idea is not if it gets violated and goes trades above your strong high and takes that as liquidity, your idea was not valid and you shouldn't trade that. Demand more price action, basically. That means they're still chasing buy side, and likely your area was wrong. So that just saved you a lot of time and money in terms of like the prop firm that you're trying to pass. It saved you 1% by saying and having a rule where if your strong high gets violated to the upside, if you're short, or your strong low gets violated to the downside, if you're long, then you don't have a trade. These setups happen every day, so you shouldn't really be in a rush to grab a trade. If you miss a trade, it's no big deal because these setups happen multiple times a day, every day. So you're gonna have that power of three in mind. And as you can imagine, for longs, obviously it's the same thing. Power of three, 1, 2, 3, starting with your strong low, right? And then you can enter for sure, knowing that there's chasing buy side, for example, on this leg right here, because that's neither one of these lows are going to be broken. Drop them in the chat box if you get that. None of these lows are going to be broken. The only low that's going to be broken is the sell side liquidity within this impulse leg that needs to be taken in order for the long to happen. Drop one in the chat box if you get that. So you can trust from when you're dealing with your first move, you can trust from this area to this area, and within the first leg, this low is not going to be broken. So you could get in somewhere within this big impulse leg, fair value gap, etc. But I personally like to wait for this second high to be broken, and I like to enter within this leg because that's you demanding more price action, and then you're also confirming the trade more, right? High made, still nothing. Buy side liquidity take. It tipped its hand to you. You're in your intermediate term lows right here. You know it's not going to be broken. You find a bearish order block or a bullish order block, my bad, in premium territory. I'm by discount territory right here, and you know that this was your previous strong high right here, and then this came up in a major intermediate term low. You can find an institutional footprint in discount territory and ride that baby all the way up to this high, and that's it. You relying on the power of three in terms of market structure showing you his hand. Drop one in the chat box if you get that. Perfect. So both ways, the power of three. If you once you get really good, you can enter on 2 and then enter again on 3. There you go, scaling your trade. Your first entry was somewhere up here, right? And your first entry was somewhere up here, right? Once you got to get really good at deciphering this, your first entry could be somewhere up here, and then you can wait for that drop. You're in profit, and then this is the third on the power of 3. This is not going to be broken. So your first entry really shouldn't stay in profit the entire time, and then you do the same thing. Boom, come back up, third leg. It's not going to be broken. Some type of institutional footprint in discount territory. There's your second entry right there. Let's just say you do two 1 to 3, short trade, boom, take profit smashed. Third leg pops up, enter again, boom, take profit smash. 6% one trade. Exactly. It's accumulation. It's exactly what it is. It's an accumulation of institutional orders and then a distribution of institutional orders in whatever direction that it's going in terms of like market structure, liquidity, bias, all of that, everything that you've learned, right? So they accumulate order, they manipulate, and they accumulate their own sell orders up here in order to distribute, and then they manipulate again down here, and they use that power of 3 in order to distribute their orders, because all banks and algorithms that run the market distribute their orders in 3 waves. They can't do it all at once, or they move each pair 1,000 pips a day. Imagine trying to trade $1 trillion and enter a trade where you're going to make $10 trillion for a central bank, and you're a human placing this trade. You can't flood the market like that all at once. You have to do it in waves. That's why the power of 3 happens. And they always do it within that impulse leg. Boom. Impulse leg, took liquidity. Now this is your new impulse leg. And if you wanted to do another entry, if it was possible, usually it's only possible for like 2 entries in a day. Yeah, you can think of it however you want. Whatever resonates with you the best. That's what I encourage people to think of it as long as you have the actual concept and how it works down, your thought process behind it could be whatever you want to. Um, I'm just trying to show you genuinely how it works, so that way you can. And this will tie into scaling in too. Once we get to the scaling portion, you'll use this knowledge to be able to scale in your trades for 2, 3 entries with context. So drop one in the chat box if you get all of that so far. So it gives you an opportunity to scale in multiple times, right? And obviously, in between these legs, in between these highs, are going to be smaller highs that'll be liquidity takes for these highs. Drop one in the chat box if you get that. So there'll be a liquidity take here, somewhere within this impulse leg. It'll take some highs out within this impulse leg in order to post a continuation. And then same thing here within this impulse leg, there will be some highs that it'll take out in order to post a continuation. So for each time that you have a sell side liquidity take or a buy side liquidity take, all you gotta do is bring out your premium discount fib for each impulse move, and then just keep moving it, and then that filters. And I'll explain what the rest of this is some other time, probably in the next live, and how to use it. But premium discount fib, and then your third leg, if you do have an opportunity, right? Premium discount fib again. This shouldn't be broken. So you have this impulse leg to work with, and you just pick your order block in premium or discount territory according to your bias, because price moves in between premium and discount territory, chasing buy and sell side liquidity all day long. One more time, drop it in the chat box if you get that and that makes sense to you. So that's kind of like what you look for in terms of structure. So let's real quick go down to back to it, the 1H real quick. I'm gonna delete this real quick. I was trying to show you how to draw that in. So you have strong high, and this is your second high right here. This is your intermediate term high. Sometimes you will have price trading above the second intermediate term high in order to post a continuation as well. I forgot to cover that. Sometimes it'll still be count as an intermediate term high. This other one, I didn't mean to duplicate that. It'll still count as an intermediate term high, this one. But this is also a very strong formation. This is when you have your strong high, your intermediate term high, and your intermediate term high. Essentially, you have the power of 3, but in this formation, right? You have 1, 2, 3. And the third high just comes back and basically, the third intermediate term high basically takes liquidity and then comes back and remitigates typically this high, your strong high in that case. So those are only, and it's the same thing for in reverse, right? Sometimes you will have price coming down, strong lows created, and then you have your intermediate term low, and then price will come down and create another intermediate term low, but never violate the actual original strong low, and you have the power of 3 again, just in a different form. And then price can have the continuation, right? Sometimes that is sell side, but that's still intermediate term low, and that's still an intermediate term high. Doesn't matter if the liquidity is taken. There's just there are just two different patterns, market structure patterns for this. It's when your intermediate term high is taking your second one, and then you have the continuation from the original order block that created the strong high, or sometimes you'll have your second intermediate term high inside of kind of pretty close to your actual strong high. So it basically just comes up and mitigates this strong high and the second intermediate term high at around this pretty much the same time, since they're pretty much close together. They're pretty much like a double mitigation. Drop one get that. So it's really about how it's formed. Let's NZD Swiss franc. Let's look at another pair that I was looking at today. It's pretty much the same pattern. Let me just delete all of this. It's pretty much the same pattern. I was looking on the daily. I did see deep into discount territory, basically filling this fair value gap right here. Drop one in the chat box if you can see that fair value gap between this candle and this candle. I'll draw it in real quick. So that's an imbalance right there, obviously. That was filled. There was a continuation from that, and price continued down, and now we're working within this impulse leg. So I'll drop down to the hourly real quick, and basically, so I'll buy side take into this hourly imbalance actually, and basically use the fact that they were continuing to push sell side on the daily from that imbalance. That the continuation buy side happened, and you had the power of 3 at strong high. You had an intermediate term high right here, and then you actually had your third intermediate term high right here. Drop one in the chat box real quick if you can see that. And also, any questions you have, let me know now. So you had strong high. I'll mark these up real quick for example's sake. So you had strong high. You had your second high, which was your intermediate term high. And then you had your third intermediate term high technically happen right here. What happened, in this case, this was the first pattern that I showed you in terms of market structure. Your third intermediate term high just basically came up and mitigated the order block right here. Actually, there was a small fair value gap. Boom, right here. Boom, right here and here. Because a small fair value gap that came up and mitigated it. Continuation. And you could have dropped down to the 15-minute or the 5-minute and used the fact that that was happening on the 1 hour as you saw it to actually get an entry on here, maybe a market execution, something like that. Once you saw that happening and the 1H fair value gap being filled, and then the actual candle turned to very heavy bearish, I would have personally sold wherever the 15 minutes was, because the 1 hour time frame is king, right? So this is how that reflected on the 15 minute. He had a displacement higher, displacement lower. Yes, there's a fair value gap literally right there, plus another an actual bearish engulfing, which once again is still valid. But in this case, I'm going to use the fair value gap. That's typically what I look for. If it does trade all the way up into the order block, that's fine, because I normally have my stop loss just behind the order block. Once again, this is the strong high. If it violates that, I was wrong on the trade anyways. And you just take an L, that's fine. So you can see how it was perfectly mitigated. You wait for price action, candle closes, etc. A few of them, and then you do a market execution based on what you see. Price did have a continuation from there. And, this is the same 1H intermediate turn high that was created. As a result, on the 15 minute, you could have got another entry right here, because that was the last thing that happened. Sell side liquidity take. This is the range that we're working in, and then price came back up, took some buy side right here actually, which was this high right here. Drop in the chat box if you can see that. It took this high right here, this candle, and that was the buy side take into the fair value gap continuation. Now we're working within this impulse move right here, right? Same thing, that 30 intermediate term high. This is how it ended up. Because the impulse moved down, there was another 15-minute imbalance right here. Price did trade above some candles right here. That was the buy side take, fair value gap, continuation, took some more sell side. So that's 2 entries right there on the 15 minute. If there would have been enough time in the day, you would have been able to write this down, maybe even down to this low right here. Drop it in the chat box if you get that. You can see that. So that's if I'm entering on the 15 minute or even the 5 minute based on that 1H, I'm looking for hella evidence, just like this. I'm looking for the 15 minute to look like this and be coming back up to fill that imbalance. You know what I mean? To be, displacement higher, displacement lower. And I'm looking for the intermediate term high, the strong high, and then 2 intermediate term highs. And then for the longs, the strong low, and then the 2 intermediate term lows in order to get in. And that's solely based off the 1H, off the daily basically sell side or buy side run. Daily is always my top bias for what I'm using for time frames, and then the 1H reflects down to the 15 minute or 5 minute, and that's pretty much the basis of how I trade. Obviously, you want to build as much context as possible, Fibonacci if you can, premium discount, etc., etc. The more higher time frame, like liquidity context you had, as you see me use, and actual footprints, like I expected the daily to fill the fair value gap and then have continuation, the better. So, any questions for me in terms of this? Real quick, is there any questions? And remember, I mark these up on the date on each one, and then you can see how they reflect down to the 15 minutes. So obviously, if I'm thinking bearish and I see all of this price action right here, including the displacements and a footprint, plus them showing me their hand a few times actually, I'm going to act on this trade and be like, hey, this is a very high probability trade because of the things that I have in front of me. I act on what I see based on where I think price is going to go, and where I think price is going to go is based on drawing liquidity. Wherever liquidity is going, that supports my bias. It has to line up, right? So if the daily is not in line with being in discount territory or premium territory, I'm not going to consider that trade. I'm going to look for more price action in the daily. If you guys don't have any questions, this is kind of like, eventually you won't have to mark these up, but I would just recommend on the hourly, if you're using that for context or liquidity or anything like that, which you should be, you mark up, you wait for the power of 3 to happen before you enter a trade. Or maybe it sets up late and you get into that same trade tonight. Now you have a trade where you know exactly where price is going and when. Very likely that same night, maybe you trade London session that night, and then you take this context and you get in on a very nice trade later on that night, right? Everything doesn't have to be right away. You might not trade Monday or Tuesday because your setup's not there. But Wednesday, Thursday, you catch 2 setups for 15% for the week. You know what I mean? Or 10% for the week. Imagine not thinking that that's enough. 10% a week, 40% a month. Apply that to $100,000 account, and you're making 40 grand a month now. So if you guys don't have any questions, that's pretty much it for this video. I'm kind of give you some context of what I look for after my liquidity for our buys and sells in terms of structure. I will see you guys in the next video, which is tomorrow at around the same time, as long as you guys' schedules are free. Yeah, no problem. See you guys.